Thank you for attending the webinar, The Dramatically Changing Office with Chris Maese, whom I'll introduce in just a few moments. This webinar is part of a series born out of insights shared by business leaders during conversations about the current and dynamically shifting COVID-19 business climate. The conversations resulted in a timely white paper entitled Resilient Realism, which LINKCO recently published. This is my way of giving back and sharing relevant information I learned speaking with business leaders on a day-to-day basis as part of my ongoing executive search practice. These anonymously shared challenges, lessons learned, and opportunities identified are highlighted in the white paper. You can let me know in the question box or via email if you'd like a copy. In the wake of COVID-19, many of the respondents have been grappling with changing economics related to their assets, products, services, remote workforces, new challenges of workflow and timetables, particularly now with the second wave of COVID-19, how to evaluate risk, work product, best practices to reassure clients and protect employees, protect assets, and keep everyone safe, cybersecurity and privacy from offsite locations, how to lead remotely with loved ones sharing workspace and unanticipated demands on normal work time, to note but a few of the insights, disruptors, and challenges discussed in the white paper. Today's webinar focuses on how we manage our commercial and industrial real estate assets and workforce with the dramatically changing office environment. We will be asking Chris to share his industry insights into how the remote, hybrid, and office work models will impact our businesses, with downsizing offices adversely in play, productivity and performance metrics, and how it's going to drive innovation potentially in security, communications, and productivity, among other questions about opportunities and trends. Our next webinar, which is it's a working title currently, Saving Underfunded Pension Benefits and Finding Tax Savings, with Robert Amoroso, CEO and Managing Partner, Gideon Strategic Advisors, will be in 2 weeks on September 9th at 2 p.m. A little housekeeping. Some of you have kindly shared your questions beforehand, and we already have a number in the queue. You may also send questions and comments in the chat box, the question area. If not covered already, Chris will try to answer those during our session. So now let me introduce our speaker. Christian Maese is managing partner for Mohr Partners, Inc. in Los Angeles. He has over 30 years of commercial real estate experience with an extensive background in national multi-site corporate tenant advisory and investment real estate sales and leasing. His skills and knowledge help support Mohr Partners' expanding global corporate services businesses, as well as Southern California-based transaction management. Chris is keenly focused on helping clients gain the perspective needed to make the right decisions to solve their commercial real estate needs. Chris, a native of Los Angeles, has intimate knowledge of the Los Angeles real estate landscape and the trends that continue to shape the city. Prior to joining Mohr Partners, Chris was a vice president at Zacuto Group. Before his time with Zacuto, Chris was vice president of real estate services for Johnson Controls. While he was there, he led the real estate transaction team of 12 professionals for DaVita Healthcare Partners and completed transactions of more than $800 million in value. Chris was also responsible for implementing strategic consulting account, portfolio, and transaction management, and local brokerage services. So I'm going to now change over to to Chris and to his PowerPoint. Just give me a second to be able to do that. Okay, we're almost there. Chris?
Got it.
Thank you.
All right. Well, thank you very much, Teri. I'm excited to be here. Great introduction, and I look forward to a productive and fun session.
I want to start off by asking you the following. Would you tell us a little bit about Mohr Partners and what is your focus in the second half of 2020?
Great. Great place to start. I was going to suggest maybe giving a little bit of background on myself, but I think you covered it. You covered it very, very well. So right into Mohr Partners. So Mohr Partners is a Dallas, Texas-based corporate real estate firm. We are privately held and one of the largest minority business enterprise certified real estate firms in the country. We have 25 to, I think we've just added a couple more offices, 25 to 27 offices domestically, and with strategic alliances around the globe, we are able to deliver both local, national, and global real estate services to our clients. For the balance of 2020, obviously the rules and game plans have changed dramatically over the last 6-7 months. Really now, what we're focused on is developing and implementing strategies for our clients that optimize their leased assets, monetize their own assets, and really the main goal is preserving and freeing up cash flow so that once the economy turns, we move past the pandemic, we want to position our clients to be able to pivot and recover post-pandemic as effectively and efficiently and swiftly as possible. So that's what we're focused on for the balance of the year. It's really about optimizing the corporate real estate holdings of our clients.
Would you continue telling us more about the remote, hybrid, and office work models that you and Mohr Partners believe will be most successful in the 1 to 5 year horizon?
Absolutely. I think the best way to do that, I'm gonna jump into my deck here, the future workplace strategy. A lot of those questions and issues will be addressed. I'll address them through the presentation, and if I don't if I don't answer them directly within the presentation, then we can address additional questions or clarifications after I move through it. All right. And if questions pop up uh, during the presentation, I'll do my best to answer them. Only caveat: I want to be able to raise my hand and say I don't know. Um, After 30 years of real estate, I think I have a good working knowledge of a lot of the real estate industry and markets, but I don't claim to know everything. So with that, let's jump in. So with the pandemic, every aspect of business has been affected. Um, Large companies, small companies, local, national, global. It's really it's really affected everyone. And what companies really now are faced with is, with the uncertainty, how do we develop strategies for our workplace? And the as the pandemic has moved deeper into uh, just move forward, it's really now becoming a big burden on facility management and corporate real estate teams to identify both short, long-term solutions for their work environments. And they're looking at providing safe and efficient environments that are uh, productive and inviting for their employees. Um, Many companies believe that the remote work environment is going to be a part of their strategy. But as companies are starting to really understand how their workforces perform in a remote situation, they're doing a couple of things. They're confirming what is effective, as well as confirming what's not effective, and where to focus their strategies in order to optimize the efficiency of their uh, workplace, and ultimately their their business. Um, it's interesting as we move forward. Um, the question of workplace density, workplace design, work space design are evolving, and there's been some interesting things that have happened just recently. Um, for instance, our firm, Mohr Partners, based in Dallas, we've just recently renewed our lease for our corporate headquarters. It's it's about 40,000 square feet, located in a Class A high-rise in Dallas. And while a lot of companies are downsizing, we've we've taken the approach for our own space to maintain our square footage. And really what we're doing is we're de densifying our space, where at pre-COVID, we had open work plan with a limited number of private offices, usually reserved for upper level management and few key individuals, with a bullpen style open floor plan. That, for our particular, is proving to be a little bit, and some of the are being compromised. So what we're looking, and it literally is something that is in progress as we speak, is we're going to a less dense environment where people, instead of being housed in an open bullpen, we're building smaller offices. So folks will have private offices, some on the perimeter window line, some interior, but this gives people a little bit increased sense of safety, so because they're in an enclosed, smaller environment, less direct interaction with a open space. We also are going to a hybrid workday where some of the administrative staff, some of the support functions are not necessarily working the typical 9 to 6 business hours. We are splitting shifts where some folks come in the morning and then leave, some come in the afternoon, so that the density is reduced, allowing people to have more space and less density. This is a little bit of a contrarian philosophy, but it's something just recently Amazon was in the news with what their strategy is. And what Amazon's doing, and this was a quote, is they're doubling down on their office space. They've recently committed to almost 1 million square feet of additional office space in 5 or 6 of their key cities: New York, San Francisco, Denver, Dallas, and a couple others. San Diego was one. And what they're doing is somewhat similar to the strategy that Mohr Partners is deploying, where they're increasing the amount of square footage they have and allocating more square footage per employee. We'd had one of my colleagues had some conversations with some of the folks within Amazon's corporate real estate group, and pre-COVID, their metric was about 180 to 200 square feet allocated per person. Pretty dense. What they've said they're doing in their go forward strategy is they're going to increase that to upwards of 400 square feet per person. So, but they're going with a less dense environment, less people, but more space. That's one of the strategies that is being deployed. And with that, they're also going to more remote officing as well. Some of the other tech companies, well known, Facebook, Twitter, What Facebook appears to be doing is they're going more towards allowing a higher percentage of their workforce to work from home. Hulu here in Los Angeles, Twitter, they've they've they haven't really decided specifically what their strategy is going to be, but they're allowing their employees to decide when they feel comfortable enough to go back into a office environment. So the tech firms, which historically have had very dense office workplace designs, are going to less density and flexibility in terms of working from home, working from the office, or a hybrid of the two. Um, the 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 overall really environment right now is one where companies just they're not sure what their ultimate strategies are going to be. One of the recent surveys done by one of the largest, well, one of the largest global real estate firms. It's not my own, but one of the largest ones in the world. Um, they'd done a survey, and this was in the Midwestern part of the United States, and a very low percentage, 2 to 3% of the companies they surveyed are considering going full remote. They feel that they will be ultimately going back into an office environment. That same survey indicated that close to 20% of companies in the same area, in the Midwest, are currently investing in and expanding their their office and corporate facility footprints. So I think early on in the pandemic and in the stay-at-home orders, companies were thinking everyone can work from home. And as things have progressed, that's really migrating to more of a traditional environment where companies are going to be uh, moving back into their office space. But there will be definite changes. A couple of the things that once decisions are made as to how to design workplaces, they're going to look at, how do we address our training and conference room and event spaces, the bigger open portions of offices. It's going to be less density, potential separating devices, or uh, I've seen plexiglass, I've seen even designs with shower curtains creating barriers. So the workplace design is really going to be looked at closely. Some of the key factors that are going to be the priorities is, like I've mentioned, more space per person, sunlight and open air are other characteristics that are becoming a higher priority. And then the other big overriding characteristics is flexibility. Flexibility in terms of working from home versus working in an office, flexibility in terms of working in a private office versus open areas, and having the ability to, in certain situations, congregate in a safe manner with multiple people, or having essentially small huddle rooms or private phone booths within an office design. So if someone has to have a confidential conversation, there can be privacy. So with the workplace design, there a lot of these factors are being considered. Again, the overriding things that are being focused on by decision makers are that the open air, the flexibility, sunlight, and space per person. So that's going to really play into what the long-term solutions are going to look like. And what we're doing from a service provider perspective is we're really trying to help our clients determine and prioritize what characteristics get them to the optimal space, the optimal protocols, and really focus on the key factors that I mentioned before, doing it efficiently, cost effectively, and being positioned to do it quickly once these changes need to take place. Here again, I've covered some of these already. The satisfaction and safety. I think those two things, concerns, if you will, they're very, very high on the priority list. Safety is really on everyone's mind. So obviously that's a very high concern, as is satisfaction. Making sure that your employees are satisfied, they're happy, and that then leads to hopefully high productivity levels and and employee retention. Um, Flexibility, again, the other flexibility factor that corporate users are looking at is flexibility in terms of their obligations, lease obligations. Um, prior to the COVID, um, there was a trend towards shorter lease terms, um, both in larger office leases, 10,000 square feet and above, as well as smaller leases. And this has just been um, accentuated by, and priority is as greatly increased due to the COVID. So corporate real estate directors now are really looking at their obligations. Do we commit to longer term leases and put money into those spaces to create the work environment that we're after, or excuse me, or do we go with shorter term leases that allow us to upsize or downsize as our business changes? And these are the questions and strategies that we're working with our clients to help them determine and figure out. And the last bullet point there, the corporate culture, that also plays into some of these decision-making factors. Some, say, for instance, a large user like Amazon or Google that have a very unique corporate culture, that culture is developed within an office space over a long period of time. So it's difficult to pick up and move and recreate that culture. So those factors are being considered very closely in determining obligations in terms of lease term. An interesting side note, and actually a question that was posed to me prior to today was, will the owners of office buildings benefit from offices downsizing or upsizing and or lease terms becoming shorter? And the investment side of real estate is one, it's not one that I focus on currently. Over my career, I have done some investment sales, everything from Class A office buildings down to little strip retail and apartment buildings. But from a ownership standpoint of offices and office buildings, there's two schools of thought as to what shorter lease terms are going to do to the valuation of buildings. As historically, buildings with long-term tenants that are high quality tenants with strong financials, that long-term commitment was the biggest driver to the value of a building. Investors felt as if they had long-term tenants and their income streams were secure, that really was the driver for value to a building. And I think going forward, it definitely will be. Now, with the change in environment, with companies in some instances going to shorter term leases and moving either into larger or smaller space much easier now, from a landlord's perspective, there's a school of thought that's saying landlords that do leases on a shorter term basis, if you're only doing a 1 or 2, even 3-year lease in today's environment, in a lot of situations, rental rates are being compressed. So if a landlord signs a short term, a 2-year lease at a compressed rate, there's a school of thought that's saying that's an opportunity to get income today, albeit a lower rate. But in 2 years, as hopefully the economy turns and then begins to recover or is recovered, having short-term obligations then allows a landlord to re-tenant at that time at what hopefully will be a future rental rate that is higher. So I think that the landlords with long-term stable tenants are going to have the highest value, but in the interim, smaller buildings that have shorter term obligations their values will hopefully remain steady, because the future opportunity to release at higher rates at market in the future will then give them or produce a higher values in the future. Okay. I see a couple of questions popping up. Let me just look at them real quick and see if I can address them right now. Let's see. Is a law preventing COVID-related or similar lawsuits? Albert, oh, you wrote both of them. Is a law preventing COVID-related or similar lawsuits required? I have to throw up my hand there, Albert, on your first question. I am not an expert in real estate law and or related legal proceedings. So I'm not sure if I can answer that question. The second one, Department of Labor has required HEPA filtering for air handling systems. Are building owners making that and other changes? If so, how is it likely to affect lease rates? I don't know. I think it's too soon to know exactly what every landlord is going to be doing. If it's going to be required by law, I think landlords will make best efforts and have to abide by any laws requirements. If they do and it adds cost, either capital costs or operating costs, most likely it will affect lease rates. It'll push lease rates up. But it's hard to know how much it will affect lease rates until a clear understanding of the amounts, if you will, that landlords will have to invest in order to meet these regulations. I hope that answered that. I took a shot at it. But any
Thanks.
any investment that a landlord makes in a building, typically, depending on the nature of it, it will will affect lease rates. Okay. All right. So I think the company concerns, workplace flexibility. I've gotten to that. That really is the extent of the presentation. Again, to kind of recap, companies are really trying to understand what their go-forward strategies are, and that's really where a lot of our focus is helping them understand the optimal environment and footprint of their corporate office space. There's a number of factors that are being taken into consideration. Safety and flexibility seem to be the highest priority, along with operating in an efficient and profitable way. And a lot of these decisions are very, very dynamic. And as we move further down the time horizon, they're changing.
So, Chris, we have some more questions here.
Mm-hmm.
But I didn't know if you had other slides that you wanted to address, or we're good. I can continue with the questions.
No, that's the end of my slides for now.
Okay.
End of my slides. Sure, I'd love to take a crack at some additional questions.
Thank you. How are the B2B and B2C evolutions impacting commercial real estate and industrial real estate from your perspective?
Good question. Very good question. Um, so I think there's three different product types that are being dramatically affected by B2B and B2C commerce and the shift towards them. One obviously is retail real estate. Um, the small local retailers are really struggling. The larger Walmarts of the world um, seem to be weathering things pretty well, uh, but there's a dramatic shift towards online commerce. I think everybody sees and knows that. So retail real estate for smaller mom and pop and local retailers, and some of the largest retailers in the country obviously are being negatively impacted. The industrial real estate is really is benefiting dramatically from this shift, and it there it's always a two-sided story when in real estate, if you're an owner of real estate versus a user of real estate. So owners of industrial manufacturing and particularly warehouse distribution and buildings that house um, logistics companies and freight forwarders, the ownership it's clearly an owner's market, particularly here in Southern California and in Los Angeles. The the vacancy factors for warehouse and industrial space, it blipped just a little bit early COVID, but it's back down to low single digit vacancies, as low as I've seen numbers 2 to 3% vacancies in industrial and warehouse space here in Los Angeles. We have a client, a large industrial user. It's a transportation company, but their facilities are housed in warehouse buildings. Um, very, very challenging market to find suitable buildings for them to operate out of. It's something that I'm doing literally as we speak. They're medium-sized users, 40 to 60,000 foot facilities. And as recent as the last couple days, we've had offers in on buildings that over a weekend, a landlord decided he was going with another company because they came in and frankly offered him longer term, more money, and he went with the other tenant. It's a very, very competitive market for industrial real estate users, both here in Southern California and across the country in the traditional uh, warehouse and distribution markets around the country. And usually it's the markets that are supporting the um, the ports, Houston, New Orleans, Atlanta, the big influx of imported goods that then need to be distributed across the country really are driving a lot of uh, that demand for industrial real estate. So um, that shift to the B2B and B2C really is impacting mostly industrial. It doesn't so much impact office, the office sector, it's kind of neutral, and then negatively impacting the retail sector.
Yeah. What about the office construction glut?
Well, that's a good question. Here in Los Angeles, there isn't really, there hasn't been a lot of office space construction over the recent past. So I'm not convinced that there's going to be a huge glut of office space. But what there is, one of the dynamics that is coming to light, particularly here in LA, the and I think it's also happening up in Silicon Valley and some of the tech heavy markets. The big tech users of office space, they have put a tremendous amount of space back on the market. So you're seeing a dramatic increase in sublease space. And I was just reading an article today. The sublease space coming on the market in Silicon Beach, which is Santa Monica, Venice, Marina del Rey, Playa Vista, the west side of Los Angeles. There was a stat that there's close to 1 million square feet of sublease space coming on the market. That number is almost 40% higher than the amount of sublease space in those markets that came on the market back in the downturn of 2009. So you're seeing the tech industry dumping space on a sublease basis back onto the market. Some of the other markets that are more what I would say traditional office users, service industry, attorneys, accountants, financial institutions, the type of tenants that are in downtown Los Angeles, Century City, Beverly Hills, they're not scaling back as quickly. So the sublease market is not being flooded in some of those more traditionally tenanted office environments. And my suspicion is that the phenomenon is probably taking place across the country in the similar types of markets, San Francisco and Silicon Valley, down south of San Francisco is seeing sublease space, but financial district is probably not. So in terms of new construction, I don't think there's going to be a huge glut of that coming on the market, because there hasn't been a huge amount of space being built.
Okay. We had a question come in that goes back to one of the points you were addressing earlier, and this this attendee would just like a little bit more explanation. Like many issues that COVID has exposed, the use of open cubicles has never seemed to live up to the promise of collaboration. Don't you think that employees will be happier and as a result more productive in larger private offices?
I think so. And I agree that the open floor plan didn't live up to the expectations of creating a more collaborative environment. I think what it did, it created environments where people thought they were collaborating, but I think when you really got down to looking at specific productivity metrics, there wasn't the productivity that I think the open space expectations were, or the expectations of the open space were going to deliver. In other words, I think people were horsing around more than they were working. There's also the open space plan. Drawback is it can be distracting, and if you can't stay focused on what you're doing, all of the distractions, noise, commotion that goes on in an open floor plan can really be distracting. So I think that yes, people might be and will be more productive and happier going back to enclosed private offices. And I think that's exactly the the reason and one of the key drivers behind what our company is doing. And real estate firms were way on the front end of going to open floor plans. And now it sounds like at least our company is going away from it to create enclosed offices to give people a little bit more privacy and and hopefully employees will be happier and more productive.
Yeah. Bloomberg recently reported that shares in logistics landlords are outperforming office and retail peers. What are you seeing here in the US and in particular in Southern California? And can you help us interpret what this might mean?
Yeah, our company, we have a number of clients that are 3PL logistic providers, and they are they are busier than they've ever been. Um, the they're being hampered by the fact that it's difficult to find large blocks of suitable office or industrial warehouse space to operate out of. But they are absolutely exploding. So they definitely are having a big impact on the markets. Just last week, one of the largest uh, leases signed in over a year was a logistics company, City of Commerce, almost 250,000 square feet by a logistics company, and that supports the theory of these logistics companies really exploding. And there have been some reports that are saying that um, the number of signed leases by logistics companies has gone up by close to 30 to 35% over the number of companies, those types of companies that were signing leases last year. So um, if you're a landlord, you own buildings that are suitable for logistics users, you're in the driver's seat.
Wow.
Yeah, it's dramatic. What the other thing that it's doing, particularly here in Southern California, it's pushing the uh, it's pushing the markets, and it's pushing geographically the boundaries of what logistics companies typically um, would like to typically um, want as far as proximities. In other words, being close to the port of LA is typically a very, very high priority. but the fact that there just is so few options, these big logistics companies are going way out into the Inland Empire, Riverside, San Bernardino, way out into the Inland Empire because there's more land, and it is allowing them to find or build things that meet their needs. And with the proximity to some of the big interstate freeways, the 10, the 15, the 40, um, logistics companies can operate out there in the Inland Empire and still service the southwestern part of the country pretty effectively.
Final question for right now. How's your surfing coming along? And what do you do to personally maintain your mental health during the pandemic?
Oh, well, my surfing has gotten really good. Um, I've, I've really tried to, during the pandemic, especially early on, I really made a strong effort to be part of the solution, not part of the problem. So we early on hunkered down and really uh, abided by all the directives. Once the beaches opened, but my office wasn't open and things were very slow, I waxed up my surfboard, and up until last week, I had my daughter with me, she's not listening, I hope. She's a better surfer than I am, and I'd never admit it if she was listening, but she is. Um, we had a lot of great time surfing together. Then she's gone off to college, so we're now empty nesters, which I think is going to lead to more surfing. Uh, but but really trying to find a good balance between um, family time, personal time, uh, business is really my philosophy on staying sane.
I hear you. I'm going to take control for a minute, and because we're coming very close to the end of our time, I want to thank you so very much for generously sharing your time and expertise. Let me just get there we go. Here I am. To address these critical and timely issues related to the changing office dynamics and the opportunities and lessons learned that businesses and investors should consider. And you gave us a lot to think about. So thank you so very much. Chris has agreed to share his slides, which are they will be available on my website, and they're also in the handouts. And a recording of this webinar, along with a summary, can also be found probably by tomorrow on my website. LINKCO Executive Search provides elite companies with top CXOs and upper management nationwide using a proprietary step-by-step process for both clients and candidates. We are on 24/7, 365. When you need help, please call upon us. The next webinar in this series is Saving Underfunded Pension Benefits and Finding Tax Savings with Robert Amoroso, CEO and Managing Partner, Gideon Strategic Advisors. It will be in 2 weeks on September 9th at 2 p.m. and it will be posted on my website. Please reserve your seat for the next webinar and stay tuned for additional topics and speakers. And of course, you have my ear. Let me know what you'd like to hear, who you'd like to hear speak, the questions that you have that are pressing for you as business leaders, and I will try to address them in my webinar series. Thank you very much for attending. Have a good morning, afternoon, and evening, and stay safe.